Welcome back, traders. So, let's jump right in. Many traders ask why a clearly defined order block on the chart is sometimes left untouched by price, even when the market pushes forward in the expected direction. To understand this, we must look at order flows. While order blocks can highlight crucial insights, they do not ensure exact price reactions. Elements like market sentiment, global events, and supply-demand shifts also drive price action. Stay tuned until the end of this episode. As we break down the full concept of order flow, we will also build a trading strategy and walk you through a refined entry model powered by order flow. This will give you both clarity and hands-on guidance for your trading journey. What exactly is order flow? Order flow represents zones of strong demand or supply, where the overall trade volume contains numerous buy and sell executions. It also covers the order block, which is a defined price level where a large cluster of buy or sell orders was previously placed. By studying order flow, traders can forecast likely market moves and locate critical areas of supply and demand. Now, let's get into it. But before moving forward, if you find this valuable, don't forget to tap the like button. Oh, and remember, subscribing costs nothing, yet the strategies I bring could be worth a fortune. I'll catch you right after the intro and disclaimer. Now, let's see how we can identify order flows in the market. Order flow refers to the area where buying or selling pressure builds up before a rally or a break in market structure. The bearish order flow refers to a zone on the chart containing bullish candles, usually 2 or more, formed before a sudden and strong bearish move to the downside. On the other hand, the bullish order flow is the zone that includes bearish candles created just before a sharp or strong bullish push to the upside. By using order flow zones as points of interest, traders can spot potential entry and exit opportunities. For example, the bearish order flow zone we mentioned earlier can serve as an entry point for a short trade, as it reflects significant selling pressure in the market. Let's dive into the details of order flow. In this downtrend example, we see the price forming a low, then pulling back to gather liquidity above the structure. Suddenly, the price drops sharply, breaking the prior structure. This zone, where price accumulated liquidity and then dropped, is recognized as the order flow zone. It represents the last buying momentum before the market drove downward, breaking the previous low. It's important to note that an order flow zone consists of at least 2 candles, not just a single one. Also, within this order flow zone, we have an order block tied to the boss movement. As you can see, an order block is essentially a refined version of the order flow zone. It's common for traders to wonder why the market sometimes ignores an order block, even if it aligns with their plan. The main reason price may not mitigate order blocks is order flow itself. Since order blocks are typically positioned at the extreme edge of an order flow zone, price can reverse before ever touching them. Always remember, order blocks are just one part of order flow and should never be the sole factor in making trading decisions. Let's move forward. In the following example, the price retraced back into the inducement zone and showed a minor pullback before suddenly pushing upward, triggering the stop losses of traders who had entered short positions within the inducement zone. After collecting liquidity, the price continued its upward run until it reached the order flow zone. At this point, it reversed direction to the downside and resumed its main trend. Once again, we have an order flow zone here. This particular zone marks the final phase of buying before the price dropped and created a boss. At the extreme edge of this order flow zone, we can also see an order block. This situation highlights that price typically respects the order flow zone more than the order block itself. It's worth noting that we use order blocks to fine-tune our strategies by defining an optimized area within order flows for entries, while also reducing stop-loss distance. This method produces a stronger reward-to-risk ratio, which is critical for consistent trading success. As shown, spotting these order flows is fairly straightforward. But before moving on, let's quickly break down inducement areas. Here, we can see the price touched the upper order flow and then moved downward without breaking the most recent structure. Later, a small pullback to the upside occurred, followed by a downward move that broke structure. This left behind an unmitigated order flow zone, which could potentially trigger a reversal. In addition, there is another unmitigated zone near the boss, which often causes confusion among traders about which one to use. As mentioned in earlier episodes, inducement zones are created by major financial institutions and smart money players such as central banks. Their purpose is to mislead retail traders into buying or selling, which ultimately provides additional liquidity for them. That's why recognizing these areas and their effects on price action is so important. For further clarity, this order flow acts as an inducement level. Price attempted to mitigate the upper order flow but instead sharply dropped, breaking the recent structure to the downside. This move produced both a fake order flow and an order block. The reason this is considered an inducement level is that the market was intentionally manipulated to mislead traders and generate more liquidity for big smart money players, including central banks and large institutions. Now, let's have a quick breakdown of the bullish order flow structure. In this scenario, the market is in an uptrend, forming higher highs and higher lows. A break of structure occurs as price moves above the previous high. This zone represents the last selling momentum before price climbed back up and created a boss by breaking that high. Here, we can clearly spot the order flow zone. At this stage, we also notice an order block in the area. However, instead of respecting it, price reversed directly from the order flow zone and pushed upward. As a trader, you might be expecting price to drop back down to mitigate the order block, giving you a chance to enter long. But relying on this method can cause you to miss profitable setups, since price may continue its upward path without ever touching the block. Waiting for that return to the order block could mean passing on other valuable opportunities along the way. Moving forward, we see another boss. At the extreme end of this bullish order flow, there's an order block. After price mitigated the order flow, it quickly reversed upward and continued its bullish move. If a buy limit order had been placed at the order block zone, it would not have triggered, and the perfect upside move would have been missed. By waiting for price to pull back and fill the order, you likely would have lost the ideal entry into the trend. Before diving into the live chart to identify order flows, it's important to emphasize a critical step in your trading journey: backtesting. Before applying any strategy to a real account, it's strongly recommended to backtest it at least 100 times. This is because a strategy's win rate is influenced by factors like market conditions, trader psychology, trading sessions, risk management, and time frame selection. So, let's move on and examine some real examples of order flow in action. On the price chart, let's examine how we can spot order flows in the market. Here, we have the Euro-Dollar 1-hour time frame chart displayed. It's important to note that order flows can be identified on any time frame, and they're not limited to a specific one. If you're using a higher time frame to locate order flows, you can always drop down to lower time frames for more precise entry opportunities. Looking at the top left of the chart, we can see a break of structure. As mentioned earlier, a bearish order flow refers to an area on the chart that contains bullish candles formed before a significant bearish movement. This zone represents the final stage of buying momentum before price suddenly dropped to the downside. In essence, it's where buyers who entered just before the decline likely placed their orders, creating a potential resistance area for price if it attempts to continue downward. Shifting our focus lower on the chart, we find a bearish order flow zone created near the boss discussed earlier. This order flow is an inducement level, designed by large financial institutions such as banks to mislead retail traders into short entries, thereby adding liquidity. However, as shown, price ignored this order flow zone and instead hit the stop losses of traders who sold in that area. Taking a closer look at the order block tied to this boss, price dropped sharply without mitigating it. Many traders were waiting for price to retrace into the bearish order block to enter short positions. Yet, price respected the order flow itself and moved down without touching the block, leaving those traders behind. This demonstrates that price does not always need to mitigate order blocks before moving in the opposite direction. The same setup occurred again. At this point, the market created another break of structure. The last buying momentum before that boss formed a new order flow zone. As we see, once price reached this zone, it reversed direction and pushed downward. Further along, the chart shows another boss. This zone, containing the final buying candles before the drop, became another order flow, which we have marked. Moving ahead, yet another boss is visible, where price formed its last bullish push before dropping. We highlighted this area as the order flow. When we map the order block alongside the order flow, Price, after mitigating both, reversed and pushed lower. A little further down, another boss appears, where we can again identify both an order flow and an order block. But in this case, price disregarded the second order flow, and it acted instead as an inducement. This occurred because there was an unmitigated extreme order flow positioned above, and price was likely sweeping liquidity accumulated in that region. At this stage, we've become skilled at recognizing order flows on the chart. In the next section, we'll explore how the order flow concept can be applied to manage profitable strategies and execute trades with precision. Suppose price has formed a bullish structure to the upside, as shown in this example. By examining this structure closely, we can clearly identify the order flows within it. Our method is to wait for price to approach the extreme order flow on the higher time frame. Once price reaches that zone, we then zoom into a lower time frame and search for a major change of character in the price action. After spotting a valid change of character, the next step is to outline the order block created by the CHOCH wave on the lower time frame. At this point, we place a buy order at the highest point within the order block zone. To control risk, the stop loss should be set a few pips below the lowest point of the zone. For the take profit target, we can either aim for the most recent unmitigated supply zone or the swing high. By following this trading approach, we seek to take advantage of the bullish order flow, maximize potential gains, and manage risk effectively. Now, let's move on and review a real chart example. Here, we have the Euro-Dollar 1 hour time frame chart, where the following price action unfolds. Initially, price broke the recent structure to the downside, made a temporary rise, and then reversed from the bearish order flow zone. It's important to note that the sell orders placed at the related order block by smart money traders were never activated. Afterward, price declined sharply, creating another break of structure with 3 consecutive red candles and leaving a clear inefficiency behind. At this stage, our main task is to identify the bearish order flow formed during the downward rally. This zone represents the final buying momentum before the strong bearish movement. Once the area of interest is highlighted, the next step is to wait patiently for price to revisit the order flow zone. As shown on the chart, price surged upward quickly with a strong white candle, penetrating into the order flow zone. From here, we switch down to the 1-minute time frame for greater detail and to look for a significant change of character. On the 1-minute chart, price indeed formed a major change of character by breaking structure while also leaving behind a notable inefficiency. Next, we highlight the order block created by the CHOCH wave. With our point of interest now marked, we place a sell limit order at this zone. To manage risk, the stop loss is set a few pips above the highest point of the area, and the take profit target is the swing low. Our sell limit order gets triggered, and we are officially in the trade. As expected, price moved downward after entry and eventually reached our take profit target. By applying the order flow concept and executing a structured plan, we secured a profitable trade at the right moment. This example demonstrates the strength of integrating order flow analysis into a trading strategy. Always remember, trading is not only about chasing profits but also about effective risk management and discipline. Success requires time, patience, and consistent practice. Don't let setbacks discourage you. Continue refining your skills and learning from each trade. Keep pushing forward, and I wish you great success in your trading journey. Thank you for watching this video. I hope you found this video both informative and helpful. Don't forget to hit the like button, and if you're new, make sure to subscribe and turn on notifications so you never miss our latest updates. We truly value your feedback and suggestions. So leave a comment below and let us know which topics you'd like us to cover in future videos. Your support means a lot, and we look forward to seeing you in the next episode.